Bitcoin scaled another all-time high and inched towards $100,000 or almost 85 lakh rupees, which means you're all gonna be very, very rich. If you too think this way, hear me out. Within Bitcoin lies a very powerful lesson in personal finance that tells us how smart money can lead to the creation of dumb money, and it can push you to take extremely terrible financial decisions. Welcome to Personal Finance TV. My name is Aaditya Iyengar, CFA, and today you'll learn about the lesser known realities of Bitcoin that will change the way you look at cryptocurrencies as a whole. I'm sure many of you will also turn into salty keyboard warriors as you watch the video, but before you do that, I strongly suggest you hear me out till the very end. I have some very strong arguments to make. Let's start by looking at some data that shows crypto's impact on India. Now, we lost nearly 371 crores to crypto losses and or scams in 2023, a rise of 45%. While Bitcoin continues to scale new highs, it is also one of the most volatile assets and it has crashed north of 75% in the past. Its volatility is nearly 3.6 times the entire US stock market. Today, some of the most controversial cryptocurrencies and NFT artworks are almost at 99% below their all-time highs. Events like the ICO mania and the NFT mayhem are just two hallmarks that tell us what happens when a society cumulatively goes crazy for an asset that doesn't even exist. But to understand how we got here, you need to understand the promise of Bitcoin. Every time you transact with your bank account, the bank is in control of this transaction. If you send 10 rupees to your friend, the bank is responsible for crediting their account with 10 rupees and debiting yours. This is a centralized transaction. The bank may restrict you from doing stuff if it wishes. Similarly, the currency that you use to transact, the Indian rupee for example, is issued by the Reserve Bank of India. They can control its supply via monetary policy. Hence, whenever the RBI prints a lot of money, we see inflation and our purchasing power reduces. This is an example of a centralized currency. Now here's the thing, some people aren't fans of this system. They think, what if these institutions turn exploitative? What if the bank starts offering favorable terms only for its richest customers? What if the RBI prints so much money that money as a medium becomes worthless? And so, Bitcoin was born. An unknown entity named Satoshi Nakamoto created it to be a truly decentralized way of transacting. But wait, if nobody controls the system and verifies these transactions, then how does it work? It's simple. Just imagine the same scenario where you pay 10 rupees to your friend, but this time you have this magical notebook that has a record of you sending 10 rupees to your friend. And here's the thing, every single person on the planet has the same magical notebook and they can all see this record of you sending 10 rupees to your friend. All of these magical notebooks are interconnected. Now let's say you use a pen and edit your notebook to make it look like you sent 100 rupees instead of 10 rupees. It would only edit your notebook. Everyone else's notebook would show the same 10 rupee transaction that originally occurred. So everyone makes transactions, these transactions show up on everybody's notebooks. That's essentially how the technology behind Bitcoin works in very simple terms. This notebook is your blockchain. In the real world, however, banks verify all your transactions and they ensure that you have in fact paid 10 rupees to your friend. In the case of our notebook, however, the verification process is a little different. You paid 10 rupees to your friend and this transaction is now hidden behind a puzzle. And it won't show up on everyone's magical notebooks unless someone steps up to solve that puzzle. As soon as someone solves that puzzle, the transaction shows up on everyone's notebook. Now obviously, why would someone go and solve these puzzles? We all have better things to do, right? Money. In the Bitcoin ecosystem, anyone can step up and solve this puzzle, and the person who solves it fastest in order to verify this transaction would get some free Bitcoin. So let's put all of this together in a more realistic sense. You sent some Bitcoin to your friend and there was a race to verify this transaction by a bunch of random people in the world. The winner got some free Bitcoin as soon as he verified this transaction. When he did that, it showed up on a ledger for everyone to see. There was no central authority doing this job or verifying these transactions like a bank. It was a democratized system that was run by the people. But wait, was it really a democratized system? Solving this puzzle got you a bit of free Bitcoin, but there was a catch. This free Bitcoin was created and given to you as a reward for solving the puzzle fastest, a process called mining. So people started using more and more powerful computers to be the first ones to solve these puzzles as transactions occurred. But the problem was this consumed a lot of energy, and all this freshly created Bitcoin that you got would be lower and lower as time passed because Bitcoin was structured such that there's a maximum cap of 21 million total Bitcoin, which means the reward would keep depleting over time and eventually stop. Long story short, mining costs a lot of energy and the benefit diminishes over time. Back in the day, it could take a small computer to get a decent amount of Bitcoin. But now it takes a full-blown mining farm to get a less than decent amount of Bitcoin. Today, the situation is such that a small number of people who have access to mining farms control most of the transaction verification that happens for Bitcoin. These are the large warehouses with a lot of powerful computers which can verify all these transactions extremely fast. Much like how a small group of financial institutions control most of the traditional transactions. The very problem that Bitcoin set out to eliminate. And you know the worst part? Bitcoin is primitive. Despite all of its promises, it can only process a measly 7 transactions per second, while more modern mechanisms such as UPI could process north of 3700 per second. Also, have you ever wondered what happens when we reach this 21 million cap? When there is no incentive left to solve these puzzles because now there is no free Bitcoin to be earned as a reward. Then the only way you can make money verifying transactions is via transaction fees. Now, what do you think will happen when a small number of people would be responsible for collecting transaction fees from an entire system? And despite raving about decentralization and being the people's currency,
we deserve a better system. Fewer middlemen, fewer fees. That's how crypto works.
Most buying of Bitcoin today happens via centralized exchanges that comply with government rules. People did see the drawbacks of Bitcoin, and soon Ethereum, another blockchain, was launched. It had one crazy feature. You remember that notebook? Well, it turns out you could now flip its pages and draw whatever you liked on it for the world to see and use. Meaning, people like you and me could build programs and create newer cryptocurrencies on the Ethereum network. Smart money such as venture capital and private equity firms took whiff of this and hailed it as the next big thing. Venture capital has a simple business model. Invest in 100 startups and hope that 2 of them do an IPO and give you all your returns. But wait, doing an IPO is tedious work. You have to comply with a bunch of government rules and be transparent. So now, instead of issuing shares and selling them to the public, every other company would instead create a cryptocurrency on the Ethereum blockchain and sell it to prospective investors, an initial coin offering. And you know the best part? You had absolutely no need to comply with government rules. You could do this whenever you liked. Companies were just spending money on advertising and marketing and showing themselves as the next big thing. Investors started to buy into the hype and applied for the ICOs to get the new imaginary coins. This would pump the price of these coins, and all the early stage VC investors would be given an exit. These ICOs, fueled by marketing, would often inflate the price of the virtual coins, and the early investors would sell, causing the price to plummet. A classic rug pull. This phenomenon was also seen in the world of artwork via non-fungible tokens or NFTs. The entire scheme was advertised this way. The way cryptocurrencies are a decentralized form of transacting, NFTs are a decentralized form of owning something. This hype also led to a lot of rug pulls. A celebrity would come and endorse an artist's artwork collection on Twitter. Fools would rush to buy it. The celebrity and the artist would dump their artwork at a premium price. Justin Bieber actually did this and got sued, by the way. But look at the reality. Who cares if you own the rights of a painting on the blockchain? What matters is whether you bought the painting or not. And there were ways to do that in the non-crypto world rather than the real world. Dogecoin, that was created as a joke, rose by 20,000% for absolutely no reason. Soon people realized that valuation cannot be infinite. Bitcoin may be all the rage today, but when interest rates went up after 2021, we all saw how so many people went bankrupt. Everyone who says that Bitcoin would go to $1 million needs to understand that liquidity is a key determinant of asset prices. The LIC IPO is the perfect example to understand liquidity. It was so huge that it drained all the liquidity in the market. People spent all of their money applying for the IPO that there was no money left to buy the shares and push its price further. If there's no money left to buy, how can we expect the prices to go up? This is the exact same principle that I use every time someone tells me that Bitcoin would go to $1 million. Oftentimes, if something feels too good to be true, that's because it is. Are you bullish on any of the cryptocurrencies? Let us know in the comments, and if you learned something new, subscribe to Personal Finance TV.